We are basically dealing with May-June 2024, paper 32 A levels. And this has two parts in it. One part is related to IAS 8. When I'm saying it's related to IAS 8, it is related to prior period adjustment. Another part is related to IAS 2, that is inventory valuation. And every part is coming for like, I don't know the marks. Yeah, but good 6 marks. One inventory valuation is for 8 marks, and IAS 8 related concept is for 6 marks. So they are covering IAS 14 marks. Okay. Now let's talk about what does IAS 8 tell before I even go and read the question. So IAS 8 tells me that suppose there is one concept of consistency. You all remember the consistency concept?
Yeah.
Consistency concept tells you that whenever you follow any accounting policy, okay, so once you follow that accounting policy, you should consistently keep on following that accounting policy and do not keep on changing the methods that you're using. Are you with me?
Yeah.
Yeah.
But this change is allowed only if the change gives a better picture or a true picture of the financial statements. And if you're going to change this to give a true picture of your financial statements, your change should be such that it should be from the retrospective effect. What do you mean by retrospective effect? That means you're doing the change, and by the year in which you do the change, you do it right from the year at which you have purchased it till the current year, assuming that you are not changing. You had done this right from before.
Mm.
Are you with me?
Yeah.
Okay.
Yeah.
This will talk with an example. Say, for example, I have a building and I decided to depreciate this at 10% from the current year. Okay. Because this is the market standard. And
Mm.
initially, I was depreciating the same building at 5%.
Mm.
From 2023, I was depreciating at 5%, and now I'm in 2025. I depreciated it. I want to depreciate it at 10%. So they say that if you want to do such changes, you have to do from retrospective effect. That means start depreciating it at 10% right from 2023 to 2025, such that you've never changed. In
Mm.
2025, your book value should be as such as you have calculated from 2023 to 2025, right at 10%. This is called
Mm.
doing it from retrospective effect. Right from the beginning, you do the same thing. Are you with me?
Mm. Yeah.
But what
Yeah.
happens is your building is of 100,000. Depreciation is 10%, so your depreciation is 10,000. And you want to depreciate it at straight line method. So in the current year, your depreciation charge is 10,000. Are you with me?
Hmm.
Yeah.
Yeah.
Current year expenses are treated as other expenses and they go in your income statement or your statement of profit or loss.
Mm.
Are you with me?
Yeah.
Hmm.
Okay. But when you are doing prior period adjustment, you cannot treat any expenses of the previous year in the current year income statement.
Mm.
Why?
Because it's income
Because
statement for the year, na?
Because it is income
yeah.
statement for the year and we follow matching principle. Matching principle tells expense for the year should be matched with income for the year to get profit for the year. That is why we make income statement for the year, and everything related to the year comes in the income statement. Anything which is not related to the year, we remove it. Are
Mm.
you
Yeah.
with me?
Yeah.
Now you want to give effect of depreciation from retrospective effect. If I say you want to give effect of this depreciation from retrospective effect, that means 2023 should also be depreciated at 10%.
Yeah.
2024 should also be depreciated at 10%.
Hmm.
Okay, 2025 you're changing the policy, so it is already 10%. And initially
Hmm.
you were depreciating it at how many percent? 5%.
Right. Yeah.
So this was already happening. Yeah.
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 Now what new you are going to do is that you have to create an expense for 2023. You have to create an expense for 2024.
Hmm.
5% extra. 5,000 you were already charging. Now you have to create 5% extra. So for
Yeah.
2023, 5% extra would be 5,000.
Yeah.
Yeah.
For 2024, another 5% extra would be 5,000. That means you are
Hmm.
creating extra expenses of 10,000.
Yeah.
But your problem is that this is prior period adjustment. This adjustment you are doing so that in 2025 it feels that right from 2023 you have been charging depreciation at 10%.
Hmm.
Are you with me?
Yeah.
But the
Got
problem
it.
over here is that I cannot write this other expenses in my income statement or statement of profit or loss.
Hmm.
Why?
Because of the matching principle.
Because of the matching principle. So the effect of this 10,000 I will give is, what will I do? I will remove this 10,000 from retained earnings. Are you
Hmm.
with me?
Yeah.
So this prior period expense will be removed from retained earnings. Current year expense would be removed from statement of profit or loss. Are you with me?
Yeah.
Yeah.
And in 2025, at the beginning of the year, your building cost would remain 100,000 and your
Hmm.
building accumulated depreciation would be 20,000. Your building net book value would be how much? 80,000.
Hmm.
This will be your beginning effect because you did this adjustment from retrospective effect. Before doing prior period adjustment, before doing prior period adjustment, this depreciation was 10,000.
Hmm.
Yeah.
After doing it, this became 20,000. Are you with me?
Yeah.
Giving you some time to think over it, I'll pause the video. So what we conclude over here that any prior period expenses would be removed from retained earning. Any prior period income would be added to the retained earnings.
Hmm.
Are you with me?
Yeah.
Yeah.
Now I have only cropped the relevant part that you need to solve, part 2A of May June 2024 paper 32. With me?
Hmm.
Yeah.
Okay. Now look over here. Company accountant has found that he has made some errors. Okay. There is some further information available where they said that land and building had land costing 175 and building costing 80,000 and land and building both were purchased on 1st of January. The
Hmm.
company's policy was not to depreciate land and building. Can you give me the meaning of this?
They did
That they
not
were
want to
not
depreciate.
depreciated.
That means right from January 2022, the company had a policy of not depreciating the land and building, and they did not depreciate the land and building.
Hmm.
Oh.
Are you with me?
Yeah.
Yeah.
Okay. So company had the policy of not depreciating and they did not depreciate. Very, very, very good. With me?
Yeah.
Yeah.
Okay, fine. Let's go ahead. 1 minute. Huh? It was the company's policy that they did not want to depreciate the land and building.
Land of building. Yeah.
Now in March, land had been revalued upwards by 35,000 for the year ended 31st December 2023. So in 2023, they had revalued the land. I don't know
Yeah.
what am I supposed to do. I am just reading. Okay.
Hmm.
Company decided to adopt new depreciation policy to be applied from date of acquisition. Can you explain me the meaning of this?
The day that we bought the land and building, from that date, we're supposed to adopt the new policy.
So there is a particular word. Company has decided that they initially their policy was that no depreciation to be charged.
Yeah.
Now that means in 2023 they have made
Hmm.
a policy. They're going to introduce a new policy will be applied right from date of acquisition, or I would say it will be applied from retrospective effect.
Hmm.
Yeah.
Yeah, where they are
Yeah.
saying that land has not to be depreciated and building has to be depreciated at 2% on cost.
Yeah.
Are you with me?
Yeah.
Non-current assets are shown at a value of 642,000. That is in your normal question. Okay. Explain how to correct the error made by the accountant clerk in relation to depreciation of the building and valuation of inventory. I'm not taking the value of inventory now in consideration. Support your
Hmm.
answer with calculations and with reference to relevant international accounting standards. Before I go and explain to you, I want you to mentally work out some things for yourself. Those who are watching the video, pause, work out, and then come back.
नहीं समझ में आया.
Okay. So now you have to show the clerk how will he correct this error. First thing that you have to do, you have to chart depreciation right from the date of acquisition. Okay. And you have to give support. You have to give relevant accounting policy to support your answer. So land was not depreciated initially and building was 80,000. That was also initially not depreciated. Correct?
Yeah.
Are
Yeah.
you with me?
Yeah.
We are changing the accounting policy in 2023. However, the effect of this change will happen from 1st Jan 2022.
Hmm.
That is retrospectively. What
Yeah.
policy you're going to charge retrospectively? Land will still not be depreciated, but building will be depreciated at 2% on cost. These are just the facts that I want to explain you.
Hmm.
Third thing that was there in the question was that in March, land was revalued upwards. Tell me, will this have any effect on the value, on the depreciation or valuation or any error that the clerk has made?
No.
It has no effect on my depreciation policy. Now, error
Yeah.
by the clerk was, what was the error by the clerk? He failed to apply his new depreciation policy retrospectively, and the company must correct the error. Yes,
Hmm.
this is what the question is telling us.
Yeah.
That means the first thing that I have to do, I have to apply the depreciation policy on the building retrospectively starting right from 1st Jan 2022.
Hmm.
Yes?
Yeah.
Depreciation on building is 2% on cost. Cost is 80,000. 2% of it is 1,600. But this is the depreciation charge of 2022 charged in 2023.
Hmm.
This is an expense of 2022. I'm repeating, this is an expense of 2022. So I would say it relates to prior period.
Hmm.
These words are important. That is why I'm repeating again. It is an expense of 2022. I am standing in 2023, that I am saying that it relates to prior period, so it must be deducted from retained earnings.
Yeah.
With me, error 1 corrected.
Yeah.
Depreciation for 2023, that is the building cost, remains the same. 2023 depreciation will be 1600. It will be charged to your statement of profit and loss, or I would say it would be charged to the income statement for 2023 as it is current year expense.
Yeah.
So to sum up, expense of 2022 would is called prior period expense, missed depreciation adjusted from retained earnings. Expense of 2023 will be charged as an expense in your statement of profit and loss, and your updated amount of accumulated depreciation would be 3,200.
Okay.
IAS 8. The name of this accounting policy, international accounting standard, is Accounting Policies, Change in Accounting Estimates or Errors. So IAS 8 deals with what will you do if you change your accounting policy in the middle? What will you do in case of errors? What do you do if there is a change in an estimate? Estimate is basically for your provisions that you create. Okay?
Yeah.
So whenever there is a
Yeah.
change in accounting policy or change in estimate or there is an error, you do retrospective adjustment. So when an accounting policy is changed, adjustments is made retrospectively to the prior period to reflect the new policy accurately. I want you to repeat this along with me. Please.
When an accounting policy
When
has
an
changed,
accounting policy is
Policy is
changed,
change. Repeat. When an accounting policy is change. Can we repeat?
when an
when an
accounting
accounting
policy is
policy
changed,
is changed,
Repeat.
adjustments must
I don't go ahead. First
when
when
an
till
an
accounting
account
policy,
come on, say
when an accounting
when an
policy is
accounting
changed,
policy is changed,
again.
when an
when
accounting
an
policy
accounting
is changed,
policy is changed,
So when you change an accounting policy, what do you do?
adjustments must be made retrospectively,
Adjustments must be made retrospectively to prior periods. Come on. Adjustments must be
which
made.
adjustments
must be
must be
made
made
retrospectively
retrospectively
to
to a
prior
prior
periods.
period.
Again,
Adjustments must be made
Must be made
retrospectively to
retrospectively
prior
to a
periods.
prior period.
okay. When an accounting from the start,
When an
When an
accounting
accounting
policy
policy
is
is
changed,
changed, adjustments
adjustments
must be
must
made
be made
retrospectively
retrospectively
to
to a
prior
prior
periods.
period.
again,
When an
When an
accounting
accounting
policy is
policy is
changed,
changed, adjustments
adjustments
must be
must be
made
made retrospectively
retrospectively
to
to
prior
prior period.
periods.
again,
When
When
an
an
accounting
accounting policy
policy is
is
changed,
changed,
adjustments must
adjustments
be
must
made
be made
retrospectively
retrospectively to prior
to prior
periods
periods
why?
to reflect the new
to
Reflect a
policy.
new
reflect the new
policy
policy.
accurately. So when an accounting policy is changed, adjustment must be made retrospectively. When an accounting policy is changed, adjustment must be made.
Retrospectively.
When
Retrospectively,
an accounting policy is changed, adjustments must be made
Retrospectively.
retrospectively
retrospectively,
to the prior period to reflect the new policy accurately. Okay?
Hmm.
And disclosure.
Yeah.
Errors must be corrected. If you correct an error, you correct the error, but you should
Hmm.
properly disclose it and show the impact on the previous period. Okay? You
Hmm.
need to learn this. So, this was your question over here. Depreciation on building, this is your marking scheme. So you need to know the name of the international accounting standard. Relating it properly to the international accounting standard would give you 1 mark. So
Hmm.
IAS 8. What is IAS 8 related to?
Accounting
Accounting
policy
policies.
changes
Policies, change in accounting estimates or errors. Accounting policies, changes in accounting estimates or errors.
hmm,
State that, states that what? You can use this line.
when an accounting
When an
policy is
accounting policy
changed,
is changed,
adjustments
adjustments
must be
must be
made
made
retrospectively prior
retrospectively
to
to
prior
prior
period.
period.
Retrospectively to the prior period affecting those changes. Okay.
Hmm.
Then you would write about your calculation. So depreciation on building for 2022 should be deducted from your opening retained earnings, and depreciation of building in 2023 it should be deducted from your statement of profit and loss,
Retro-
and it
yeah.
should be deducted from your non-current assets. You should deduct total 3200. Okay, just
Hmm.
have a look at it. This completes part 2A of your paper 32 May June 2024.